There are many ways to fund a commercial property, and we look at the vehicle used to buy it, a limited company, buying it in a partnership name or an individual's name, looking at a trust and other methods, and then also considering how that's funded. And if we look at the difference between a limited company and a private individual, first of all, and I've put private individuals and partnerships in the same category, it's always been the case, up until recently at least, that when a borrower borrows money to purchase a property, the interest on its loan is tax deductible. In other words, it's a cost against its profit and loss account, reduces the taxable profits, and when we go from there, the tax bill goes down. A few years ago, the legislation was changed, and the tax relief on loan interest for individuals and partnerships was lost. It's only available to limited companies currently. That might change in the future. The government tends to think that property investors have plenty of money, can afford to pay the extra tax, and they may change it so that all investment property loans have no tax relief on their interest. But I'm speculating. It's a possible direction of travel. Or they may vary it according to only certain types of properties attract tax relief on the loans. So maybe commercial would, residential wouldn't. But we don't know yet. We're going to deal with the circumstance as it currently presents itself. So limited company or private individual partnership, I would tend towards using a limited company to do that. We've discussed SIPs already. That's another method. And then a third one could be, for example, setting up a trust. That's where the trust, which would be a limited company, a special purpose vehicle or SPV, buys the property, but the ownership of it is vested in the beneficiaries, the ultimate beneficial owners. Now, there might be a tax advantage there if the ultimate beneficial owners were family member children, for example, who aren't taxpayers. They are receiving profits from the investment, which aren't taxable if it's below their individual tax threshold. So that's another possibility. There are certain lenders who will fund those, but the number of lenders doing so for trusts is reducing. There's concerns about the source of the funding, the anti-money laundering regulations make it more complicated to do it that way, and there's one or two extra layers of legal due diligence required. But it is still a tax-efficient method of doing it if the lenders will accept it. Now we've talked about lenders. I think it's worthwhile just considering the different ways of funding the property and with whom. The lenders probably fall into three different categories or three different tiers. Tier one would be the high street banks, Barclays, Lloyds, NatWest. I exclude HSBC. They are doing investment property loans, but usually only about £10 million plus. So for the majority, we're looking at those three. They traditionally were the cheapest. They tend to do lower loan to values, so a little bit more risk averse, and have become much more so since the financial crash and the controls imposed on them by the regulators to avoid any future problems. They're very selective in the type of assets they'll consider funding. Some will not touch under any circumstances high street retail investment properties. Others are a little bit more flexible, but generally speaking, high street banks are cheaper but lower loan to value, more cautious. Second tier, tier two, is the likes of Aldermore, Shawbrook, Synergy Bank, YBS Commercial, people like this, who will be slightly more expensive than the high street, have a little bit more flexibility in the type of properties that they're prepared to lend against, even providing longer repayment terms. But they will also go for a higher loan to value in a lot of cases than the high street banks will do. So a little bit more flexible. And the third option would be peer-to-peer lenders. These are the most expensive. They tend to be private organisations who raise funds from depositors and then lend them directly on to borrowers. So we've said they're the most expensive at the higher interest rates, and they tend towards providing short-term finance rather than long-term loans, although they can be more bespoke. So three different levels of lenders. I think that then leads me on to thinking about some final points to remember. And there are probably three broad ones that I would raise at this point. First of all, don't just rely on your local high street bank manager. I was one for very many years, but policies have changed. Their credit appetite has changed as well with the influence of the regulators following the financial crash. And they are probably in some cases becoming more cautious. And certainly their loan to value figures are much lower. That's point one. Point two, get a broker to do the legwork for you. The broker will know the market, he'll know the lenders most suitable to this individual deal, this individual property, this type of investment. Once he's researched the market, he will present the options to the client, and it's the client who chooses, so the client remains in control. And the other thing about this is that it's, in most cases, the lender who pays the broker's fee, not the borrower, over and above a small admin fee, just to cover the initial assessment period. So yeah, get a broker to do the work and research the market for you. It's very time consuming, and lenders' policies change greatly, not just according to the lender, but according to the individual deal. And I think finally, and just rounding off back to the point of the tax situation and SIPs and the like, I would always say get a good accountant on board to advise on the tax position, including the pensions side, and making sure that you're making the most of your pension allowances, and the appropriate way of doing that, because legislation does change on a regular basis. And it's very important not to be caught out.